What's up, guys? Today we're going to do a quick analysis of PayPal, an incredibly popular retail stock. Uh, it's okay. We'll go through some numbers and I'll tell you why. It's okay. It's all right. And we've got let's look at the 5-year chart. 5-year chart. They are down a lot from their all-time high, around 80%. Man, imagine if you bought up here, you'd be dying right now. But maybe with them being at this price and being suppressed for so long, maybe this does present a buying opportunity, and we're going to check that out today. They are a $71 billion company, so pretty large company. Price to earnings ratio of 17, which is not bad at all. Let's take a look at their revenue numbers. Here is their annual revenue numbers, 13 billion all the way up to 30 billion. And in the past couple of years, they've had 6% and then 10% growth. So not too bad. They're actually pretty good. And their earnings follow fairly closely. Like their net margin stays pretty consistent. Like it's not perfectly consistent, but it's all right. In terms of their balance sheet looks actually really, really good. Negative 2.5 billion in net debt. So actually really, really good balance sheet. I didn't really expect that when I pulled them up, but they actually do have a very nice balance sheet. In terms of cash flow, they are doing a lot of share buybacks, which is something that you would like to see, I guess. With their price possibly being suppressed, then I guess it is a good thing to see a lot of stock buybacks. They are doing more stock buybacks than they have in cash flow. So they are taking out debt to do that, which I don't know if that's the best strategy in the world, but hey, I don't know. I don't know what management is thinking with that, but it might be a good idea, might not. In terms of statistics, let's take a look at their net margin. Or their return on invested capital right here is about 13%. Usually the return on invested capital has a pretty high correlation with the net margin. So that's what you're seeing there. And operating margin at about 15%. And then the net margin is slightly lower, although it does look like last year they had a 17% margin. I would say about 15% net margin would be fair for this business. Let's go to their investor slide. Oh wait, right here. I found some of their slides. In terms of payment volume, they are up 13%, revenues up 8%. Their transaction margin is about the same. They had, monthly active accounts. I think this is the reason why the stock has gotten beat down so heavily, is because their monthly active accounts is not growing at all. They just have like higher transaction values, I guess, with the current accounts that are active. So it's kind of like very stagnant in terms of growth with their active users, because they are in a highly competitive industry with payments. They're competing against Visa, MasterCard, also Apple Pay, Square. There's so many different payment options that people have nowadays. And so it might be difficult to compete, and also the margins might get hit even harder than like 15% margin is not like amazing or anything, and it could possibly even get worse. So that's the risk you have when you're buying this business. But I did find the analyst estimates, so we are going to plug this stuff into a DCF model. We've got a average estimate of 4.66 for next year, and then the year after that 5.15, and then for revenue estimates 29.5 billion going up to 31.8 billion. That's the analysts are expecting about an 8% increase over year for into 2025. So I put that into the model. Let's zoom in on this. I put in their EPS estimate, revenue estimate, buybacks of 4 billion. They did like 5 billion last year. I think 4 billion is fair. Net debt of negative 2.5 billion. Exit multiple 15. I do think that's fair because I I don't see that their growth is going to be like they're super high. So I think an exit multiple of 15 is fair. It is possible that they have multiple expansion up to like maybe 20. But I'd say 20 would be the highest you'd want to go for exit multiple. And then discount rate of 10% because I want a 10% return on my stocks. In terms of earnings growth, I put 7% going down to about 3% growth. because they do have lots of competition. With the earnings model, $72 a share is fair price, and I really like to use the revenue model, so let's take a look at this one. For growth, I have that 7% that they have projected. Well, 7 or 8% is what they project, so I'm just being conservative with 7%. And then going down from there, so 5% moving forward. It's possible that this is higher or lower. Not It's impossible to know exactly how it plays out, but being logical, I think that 5% is fair for PayPal in terms of revenue growth. It's possible that they don't grow at all. It's possible that they grow more than this, So, and then for profit margin, I put 15%. It's possible that their profit margin gets hit as well. It might go down to about 12 or 10%. But last year they did 17%, so I think 15% is fair moving forward. And so that's what I put. And if this situation plays out, then we can say that the fair share price is around $70. So with their current price at 66, they are fair price, and I would say that you'd be expecting about a 10% return moving forward if you bought PayPal today. So yeah, a lot of a lot of the creators in the space think that PayPal is like a screaming deal and that you're going to see like 10x returns, but no, it's not going to happen. Like unless these growth projections are way off, uh, they're not going to like give you eye-popping returns or anything like that. Although it is a 10% return is not bad at all. So, um, like I don't currently hold them in my portfolio, but it's possible that I might add them, seeing this DCF model. But we'll see. I don't know. They are in a competitive industry, and there are risks involved with the stock. So, yeah, if you guys want to try your own numbers, like maybe you think that they're going to grow more and maybe they get a profit margin of like 25% somehow, then you could put your own numbers into this DCF model. Just check the link in the description. I let anybody use it for free. And yeah, leave a comment if you have any questions. I make sure to read all the comments. Otherwise, yeah, hit that like button and I'll see you in the next video.